Why now?
Well, there are two primary reasons. The big rumor on the street is that they're doing this to bolster the net asset value of KKR Private Equity Investors LP, this Dutch subsidiary, which is the only fund that they've been running in its 32-year history that's running at a loss, and it's down about 60%. The second reason, arguably, is to expand their base of business. They're doing it at a time when the LBO market's dried up, for all intents and purposes, and that they're expanding to other areas of business. So I was thinking about it. Why now? This is a great time to poach other people. When all the other investment banks are sucking wind, why not come out? You now have publicly traded shares that you can offer people as a carrot at the end of the stick to get them to switch jobs.
So the money that they were paying before wasn't enough of a carrot?
I don't know. You got to figure that out when you talk to your friends on Wall Street.
I'll have to do some more of that now that we know that this is happening. Does this signal at all that KKR is in tough straits, in desperate straits?
In and of itself, it's not indicative. The fact that they tried to do an IPO last year and are now doing it in a different way aren't necessarily. The thing that I also found interesting, that the valuation from what I read is at 10 to 12 times earnings, whereas Blackstone, which is deemed to be one of its competitors, is trading at about 13 times earnings. So it's being priced at a lower amount than what Blackstone is trading. So the question is, if I'm getting the stock, am I getting it in with a built-in pop that's going to occur?
Well, Blackstone certainly hasn't seen a built-in pop. I mean, are there any lessons to be learned here from the story of Blackstone and the decline that we've seen in the shares since its IPO?
Yeah, that investors really need to understand what they're doing before they go in and jump full feet into either private equity or hedge fund industry. But the other thing that I found of interest, which I haven't really read anything about, is they're swapping equity, 21% of KKR, into the fund for its assets. So they have to value the portfolio. Now, what happens if they undervalue the portfolio and it's 3 or 4 or 5 years from now, and KKR now owns the value of these investments, and they're selling off at 5, 10 times cost? Question is, they need consent from the unit holders of the private equity fund, but I don't know Amsterdam law. I'm not an Amsterdam lawyer, or Dutch lawyer, I should say. But even given the consent, will investors come out of the woodwork who've consented to this transaction later on to sue, claiming that they were provided inaccurate information, that's why they consented to it? Unless the documents build in some seesaw concept where there's going to be a different splitting of the valuation of those portfolios if they come out at a pop or 3 or 5 years from now.
Now, as we know, I mean, these types of firms, and KKR in particular, famously not very transparent. It's a public-private company. Why should it be? What are you looking to perhaps find out about KKR that you didn't know? I mean, things like what you're talking about in terms of where it values the assets.
Well, there's going to be greater financial disclosure, how they run their business, employee compensation, best practices. It's not necessarily clear what information is going to come out or what's not going to come out.
Well, the other big thing about this switchover, huge cultural change, perhaps even more so than at something like a Blackstone. How is the company going to have to run itself differently now?
Well, they've been modifying the last several months. They've hired people in anticipation of this transaction that have come from more of that type of background, and apparently with the intention of going public. Now, the question is the key principles. This is no longer their private boutique. They have to answer to people outside of their own firm. I have to imagine they're 64 or 65 years old. They have an expectation of what that means. They're not necessarily doing this to, I think, maximize their own valuation to get out of the business.
Well, and that's something that they have said very explicitly. They're not looking to cash out here. It's more of building of long-term value.
That's what they're saying.
So do you buy that argument?
It seems to be that way. I'm sure could have looked to other buyers to buy it, not necessarily at this time in history, but either 2 or 3 years ago, or maybe 5 years from now when we're in a different cycle.
Okay. Ron, thanks very much for coming on and talking to us about this. We'll have to check again when the company starts trading and see if people are buying.
Sounds good. Thanks so much for having me.
Okay. Thanks a lot, Ron Geffner, joining us from Status and Goldberg. And coming up next, we'll be talking about who gains and who might lose out from the housing relief bill awaiting President Bush's signature. We'll take a look and also at the possible fallout on companies and investors when we come back. We've got the financial group trading lower today, incidentally. Fannie and Freddie had been showing some early gains. We'll check back in when we come back.